senior economist at the Rand Corporation, which is a think tank, and professor of public policy at the Party Rand Graduate School. Previously, he was director of the Center for South Asia at Stanford University and has worked as an investment banker, venture capitalist, journalist, and agriculturist. Dr. Dosani's Jamati service includes work as the chairman of the Aga Khan Economic Planning Board for the United States and for India, and chairman of Focus USA. He currently serves as a member of the steering committee for the Agreement of Cooperation between the Imamate and the State of California. Next, we have Mayur Lakhani. Mayur is senior partner at Queen's Court Capital, a private equity firm focused on special situations investments in the middle market. He has been involved in finance and banking for over 25 years. And prior to Queen's Court Capital, he was portfolio manager at Lord Abbett & Co., where he co-headed distressed and special situations investments across all of the firm's funds. He has also worked as an investment banker at UBS, a distressed bond trader at Deutsche Bank, and as a hedge fund portfolio manager at Tricadia. It is truly an honor to be here today with such an accomplished professionals. Thank you both for being here.
Yeah,
As many of you know, the Economic Planning Board released an economic advisory a few weeks ago around navigating shifts in the US economy. Some of the topics discussed were tariffs and economic policy changes, inflation, business sector performance, and real estate, to name a few. The full advisory is available on the Smiley USA website for your reference. Today, we'll expand on those topics, including what's changed since the advisory, and also get our panelists' thoughts on what they see ahead. I'd like to start the conversation by laying some groundwork of where we are in the US economy at the moment. Dr. Dosani, when looking at the current state of the economy, where do we stand? Could you speak on current economic conditions and how should we think about expectations of economic performance coming up?
Thank you, Zoeb. Yali Madad to you and to all our audience and to my fellow panelist, Mayur, and to all those at EPB who've taken so much effort to organize this. Thank you for introducing us as incredible panelists. I'd rather be credible than incredible in this session. So, to give some perspective on the economy, I'll show you a slide in a moment which shows the uncertainty that's going on. But in terms of perspective, I think the main message I'd like to convey is there's a high level of uncertainty now about where the US economy is going. Now, some of that is due to the leadership issue. You have a president who has a direction for the economy that other people still need to understand thoroughly if they want to really go with it, benefit from it. So I think understanding that perspective is important. But there are also other things going on. For example, what is happening around in the world. China has become a very powerful country in the last 2 decades. And so that's playing a big role in how policy here will go and how the economy of the US will do. For example, the US used to have a big shipbuilding economy about 20, 25, 30 or 50 years ago. Now, last year in 2024, the United States produced just 5 ships, whereas China produced 1,700. And it has about 70% of the market share. So you're looking at a completely different situation now in terms of where the value is created, how we have benefited or not benefited. You know that the US has been moving more towards a service economy and away from manufacturing. That has served us well, but there's the question of how important is manufacturing to the economy. So I think these are some of the issues that I hope we can talk a little bit more as we go and get into this session. I don't know if Mayur, you or Zoeb would like to say anything before I move to the slide and explain it a bit.
Please go ahead.
Yeah, I just wanted to kind of just dig a little bit deeper. So do you see that fiscal policy and government changes impacting the broader economy? Do you see it impacting more of the kind of various sectors, like you mentioned, manufacturing? How do you see that kind of playing out at the moment?
So, yeah, so policy right now is, I mean, focused on a few things. One is tariffs, and the other is tax cuts, both of which, President signature initiatives. I think the issue has been the uncertainty. Many people are worried that this is an abrupt change. I mean, for example, if you look at higher education, where there's been so much change, the Department of Education at Washington, Central One has been pretty much shut down. And that has meant that research in education, the whole flow of students coming through a certain cycle of education is going to change completely. So we should talk about that in more detail. But I think it's this abruptness of change that is the worry. So I would say let's first focus on the uncertainty. Fiscal policy in terms of tax cuts and so on are just Trump is basically asking us to continue what he did in his first term with a little bit of change. But Biden continued with that. It's due to expire. He wants it renewed. Monetary policy is a big issue right now with the Fed taking a different stance, a much less cooperative stance with the Federal Reserve Bank, which sets interest rates, a different stance. So all these things, I think, are really, really important to discuss. Yeah, and we should. I'm happy to get into any detail you'd like.
Yeah, and just a quick follow-up. So you mentioned uncertainty, and so kind of wanted to dig a little deeper. As a community of recent migrants, what aspects should the Jamaat be kind of aware of? And even what are aspects that they should take advantage of during this moment of uncertainty?
Yeah, so let me just caveat our statements. I think, we're not trying to particularly evaluate any particular president or administration. It's just how things are changing over time that we need to be. And there's certain long-term trends. I think any president at this point, and we saw it in President Biden as well, would want to encourage manufacturing. That's why you had the Inflation Reduction Act, which brought all TSMC and other chip makers to set up plants in the United States. President Trump is trying to accentuate and accelerate that trend. I think, Zoe, let's go to the first slide, and then I can
Sure.
talk a bit about the community. Yeah, would you go to the next slide, please? So here you get a sense of the great uncertainty. So if you look at that, the blue chip consensus line, which is, starts at 2% on the left, what you'll see is, pretty steady forecast of the country's projected economic growth for the first quarter. That is, first quarter that ended in March, for which the official figures are still awaited. So you can see what we call the blue chip estimate, which is the top forecasters from the private sector, including such illustrious names as Goldman Sachs and others. Undoubtedly, Mayur's firm is there as well. But what you can see is that there was the steadiness, and then around 22nd of February, when the tariff news started coming out in real earnest, and President Trump was saying, I'm going to do this and that, I'll double tariffs, and and he actually imposed tariffs on automobiles and so on. Then you had this the blue chip slowly coming down, and you can see that that shadowed area is the maximum and minimum range of the top 10 and the bottom 10 forecasts. And then in recent days, in April, it's gone up again, but it's still significantly lower than what we started the year with. Now look at the green slide, or the green line, and what you see, not the dotted one or dashed one, you see the solid line. That's a forecast made by the Atlanta Federal Reserve Bank of coming out of Atlanta City. Now, what they do is make forecasts based on the official methodology of the government, which is put out by the Bureau of Economic Analysis. But the data they have obviously is not as good. So they're constantly adding data. And by the time the quarter ends and the forecast comes out from officially, which in this case will be by the 30th of April for the first quarter, their forecast will match. But what you see here is a sudden decline. When the blue chips went down a little bit, the Fed went down much more. And currently, if you look at that somewhat shocking statement on the right side, you're at minus 2.5%. I mean, they're actually forecasting a solid slowdown. I mean, and if this continues for another quarter, we'd say we are in a recession. At the same time, we're seeing the blue chip forecast much higher. So this shows you how uncertain, you have credible forecasters, widely different in their forecasts. And I think this is where we have to be very, very careful about how we as a Jamaat want to position ourselves over the next 9 months to a year as these uncertainties unfold. So, that's my, so yeah, you asked Zohaib about the immigrant situation. So, we are a nation of recent immigrants. I mean, the United States is a nation of immigrants. But we are relatively recent. I mean, if you look at the initial wave of migrants to the US, who came from Northern and Western Europe, they came in the 1880s onwards. And you had the Southern and Eastern Europeans coming in the 1920s, and you had the sort of the Asian and Mexican sort of Hispanic wave, which began in the 1920s and then 1950s. But really, our community was significantly present really only from the late 70s, early 80s onwards, and has grown substantially since then. Now, why that matters is it takes time. A lot of studies have shown it takes time for a community to adopt the ways of the mainstream. And they may not want to, in all cases, do that. So assimilation of a community into the mainstream in terms of the economic behavior, the cultural behavior, that takes 2 or 3 generations to happen. What we are seeing is really the first and second generation at work now. And what that means is, for example, things like housing, much, much more important to a recent immigrant community than a long-standing one. A long-standing immigrant community will buy when they are ready to buy. We tend to say, we've come from a difficult situation into a much better situation. We want housing right away. And that's been the trend for hundreds of years of all immigrant communities coming to the US. So I think housing, therefore, should be more discussed in this webinar than many other things, because that's really important. In terms of handing down, to the next generation, the first generation immigrants are much more concerned about those things. In terms of spending habits, you'll find it's only in the third generation that people start spending like the mainstream, or they worry about jobs much less than first and second generation. So that's where those factors matter.
Yeah, thank you. And I kind of just want to take a step back. You during your kind of analysis of the movement of economic performance and GDP, you mentioned tariffs. Could you briefly explain what a tariff is and what do tariffs have to do with U.S. trade policy?
Yeah, and then I'd like to also explicate a slide. But tariffs are basically, an import tariff. You can have export tariffs and import tariffs. Import tariffs are tariffs that commonly the word tariff refers to, which is a fee that is paid by the importer in the country of import. So, when the administration levies a 20% tariff on something, it comes in for $1, and then the importer has to pay 20 cents on the dollar, and so it's not paid by the exporter. But obviously, if the price goes up, the exporter will have less demand for their product. And a tariff is also not what we were discussing just in a lighter vein. A tariff if you say in Urdu, you said tarif, it means praise. A tariff is anything but praise. It has to be paid. I was just joking with my colleagues that when the Prime Minister of India was here in February, he went back and told his colleagues, "Oh, all I heard was tarif, praise for what we did." And so I said, I must reciprocate. I said, I will give you reciprocal tarif, which didn't go over too well. But tariffs are, tariffs are actually very significant for a simple reason. China, which is heavily tariffed, is the sole supplier of many, many items that can't be replaced. If you just look at a common item like a toaster. So a toaster, maybe you can get one for $30 or around that, got a good one, a little more. 100% of the import of toasters comes from China, 100%, okay? Now, if you stop that by putting 145% duty, which is the situation right now, a tariff on it, what will happen? Will the US market be able to produce toasters for 145% plus $30, whatever, $50, $60? Answer is no. They cannot produce in scale. And in addition, all the parts would have to come from China and have to pay those prices. So it would take 2 or 3 years. Where would we get our toasters from? If you look around in the world, the only other countries that make toasters are the very high-end ones, like in Germany and Britain, where you can get, a Ritterwork toaster or a Dualit toaster for like $180. That's not going to help the middle market get its toasters. And that applies to a wide range of items in the US. So, tariffs are significant. So, what I would like to show you now is a slide which brings out some of these issues. Could you go to the next slide, please? So let's look at, how inflation, tariffs, and exchange rates and everything come together. So the first slide is ask the question, okay, we've seen 2.5% interest rates, inflation rates lately, but if you accumulate it over a period of time, it's a lot. So what this chart shows you is that if you had goods that cost $1,000 in 2020, today what do they cost? So they cost over 21% more, 1,212 at the end of 2024. So that's a lot. If it's not 2% a year, it's been up and down. COVID certainly played a role. Now let's look at how our earnings have changed. Next slide, please. So earnings are keeping pace. So the good news is that after many years of where earnings were falling behind inflation on average, now what we are seeing is that earnings are keeping pace. So the blue line gives you the income movement, which is from, on this common base of 2020 being 1, and that's gone up to 27%, even as our inflation has gone up by less. So that's good news. But now we come to the real kicker over here. Can you go to the next slide, please? So here is unfortunately something that's is not commonly taken account of, but is actually very important too. So you look at the income; it's that same income line as in the previous graph, and you see it going up. And so right now, our income would be this is for a family of 4, typical family of 4 size, so over 100,000, 110,000 or so. Then you look at the tax rate, or tax that family pays, and you see it's gone up a little bit, but because the rates have been quite favorable, you're not seeing it change. So that's the red line. And then you look at constant real consumption, assuming that you're not able to afford more than you could afford in 2020. You want to at least maintain your rate of consumption in real terms. In money terms, it goes up a bit, but not significant. The real problem is the mortgage. Even if you look at adjust for historical mortgage rates, the current mortgage rate might be 6.8%, but if you look at historical rates and take an average, today people are paying 4.5% on average for their mortgage. If you factor that in and then look at do this for the typical family, what you see is mortgage rates have just shot up. The mortgage amount has just shot up from 1,161 per month per family to about 2,200 now. And what you're seeing is the annualized number. With that happening, you look at savings. You see, there is where you see the problem. We've gone down from savings, which is on the right-hand side axis, from about 12,000 a year being saved to close to 0 in 2023 and some recovery in 2024. So what this shows you is that the economy is at a point where we need to really think what's going to happen to inflation. Is it still going to affect us like this? Are mortgage rates going to stay so high? What is the prospect for these things improving? We saw that in the GDP numbers that the forecasts have all come down sharply. Behind that, there's a story about savings, interest rates, and inflation that we need to talk about.
No, thank you. And so for what I'm hearing is that there is a varied impact of both existing inflation in the market, and based on your definition explanation, thank you so much for that. On tariffs, there also is an impact there that could impact inflation, at least to consumers. But then, kind of thinking it on a different side of the coin, and Mayur, I'm going to probably ask you, how do you see businesses kind of navigating both rising costs from tariffs, but also what opportunities do you see also arising in this inflation plus tariff environment?
Yeah, sure thing. So again, let me also echo Chairman Dosani's appreciation for including us on the panel. Hopefully, will be helpful to you guys in the Jamaat. In terms of tariff, I think you said something that tariffs are inflationary, and I just wanted to make sure kind of I piped in that I'm not sure that story has been settled. I think at the very least, tariffs reset the price level higher. However, whether that has an inflationary impulse, whether that continues through and causes inflation every year, again, inflation is a function of the expectation of price rises over time. And so if we think that will impact the labor market and increase, payment for labor, and that goes into sort of increased price levels again, and that has a recursive effect, that's what typically is thought of as inflationary. So here, potentially it's inflationary, but we haven't seen that yet. And again, my personal view is I don't think it will be. It'll just be a reset of the price level. In terms of the way that's impacted business, I think what we're seeing is a couple of things. One actually, one interesting thing that I noticed is that just like the markets previewed or were anticipating these tariffs, so were businesses. And so they tried to get ahead of them by increasing their purchases of goods and raw materials in advance of the oncoming tariffs. Now, of course, they turned out to be a lot more significant than anyone had thought. However, businesses were still preempting those. And so we saw, what we call a buildup in working capital. Working capital is just effectively the amount of inventory and the amount of receivables that a business has. And so buying more inventory and slowing, again, their customers were slowing down paying to them, you saw a widening, sort of gap in working capital, which necessarily needs to be financed by businesses. So
I'm sorry to interrupt. I'm not an accountant. Could you just explain working capital for me?
Yeah. So again, working capital is just basically receivables to a business, how much their customers have to pay them, and the amount of inventory a business keeps every day to do its business. Now, both things are effectively need to be financed, right? A business pays its employees every day, it pays its rent, it pays its utilities, but if it doesn't get paid by its customers immediately, there's a gap in funding between what they collect and what they have to pay. That's what's called the accounts receivable, accounts payable gap. And then inventory, of course, you have to purchase your inventory before you sell it, and so that build up in inventory also costs money. So we've seen businesses have to pay for that build up in working capital. Now, over time, as the tariffs have kicked in, will they work down that working capital, and delay purchasing new inventory? Perhaps, and I think you may see that liquidity transfer from a buildup in the working capital into cash. But so far, businesses have had to tap bank lines. They've had to sort of spend their own excess savings, potentially equity capital, to build up that working capital. I think the other thing that we saw is that customers or companies have been finding the old saying, like, water finds the path of least resistance. So, now that these tariffs have been announced, there's a chemicals company that I'm working with that's calling around very quickly to figure out where they can source their chemicals, if not from China. So, Panama is an interesting place because the tariffs there were fairly low. And so, again, the global supply chain is figuring out what paths to take to get supplies to the US at their least cost. So what this means is that the eventual cost of inputs will go up. Will they go up as much as the 125 and 35%? Likely not, especially if they're coming from China. Now, will those pathways get shut down? Potentially, but at least to date, what we're seeing is businesses finding paths to get their supplies through other channels, and through tariff, countries where the tariffs are impacted them less.
Gotcha. And so, you kind of may potentially touched on the question I was about to ask next is taking a step back and kind of really understanding the global trade policy developments that we've seen in general. What opportunities can businesses reliant on global supply chains, and especially in the US, those reliant on imports and exports, take advantage of in this environment?
Well, again, the good news is that it's not just your costs that have increased, it's everyone's costs that have increased, which means that you now have, if you have the liquidity, if you have the ability to invest, you're not disadvantaged in investing in your infrastructure. Whereas historically, if everyone's prices were low and you invested in infrastructure, and automation and efficiency, your costs have now risen more so than everybody else has. To the extent that everyone's costs are going up, if you can now invest in this as costs come down again, you potentially have an advantage. So what we've seen customers or sort of companies think about, the one thing I'll also say is that having come through COVID, these supply chain issues had been problematic before. So people are kind of used to now having some redundancy built into their supply chain. So it's not like the first time they're seeing this problem. That said, I don't think anyone believes that that there's going to be a shift, of more outsourcing or more offshoring. I think people realize that it may not be this bad forever, but we're not going to go back to the, to the open and free trade that we've had 15 or 20 years ago. And so I think the ability to invest in either, local supply, local efficiency, again, at the end of the day, a lot of it is labor costs, right? So finding a way to reduce that cost of labor, that cost of input, is probably worth spending on now because the return is greater. If that makes sense.
Can I comment?
Yes, please.
Absolutely.
Yeah, I just wanted to, point out that yes, I would agree that if some items, when you import them, if there's a tariff, the cost of those items will go up, but it's not. That doesn't mean that inflation will be generally up because other prices might come down. Historically, actually, that's been the case, except when very sharp disruptions occur. For example, the OPEC-induced oil price hikes caused general inflation in the US for several years, along with stagnation, and you had what was called stagflation. The question is whether these tariffs will have that same huge effect. My sense is it will. But even then, the system could adjust to that over a period of time, as Mayur, you pointed out. How quickly it can adjust, those are, I think, the questions that are very important. I'm not against the idea of more employment for manufacturing. I think that's a really good thing. I mean, the US economy has for years been taken for a ride, by European countries and several other countries paying low tariff, because they've created tariff walls. I mean, for example, in places like Japan or Korea, it's very hard to open a retail shop by an American company. There are none. There are no brand names really in retail or even in banking in Japan or Korea from America because of their non-tariff barriers. So there's a lot of reality in what President Trump is saying. How you tackle it is where I think the issue is problematic. It's nice to have a strategy to increase manufacturing. If you raise tariffs, manufacturing will rise. But it's going to be making things that don't make sense for U.S. wage rates to be used for. I gave the example of a toaster. There are hundreds of such items where there is no way that the U.S. is ever going to be able to be competitive in manufacturing those.
And I guess, Chairman Desai, that goes to the point of, what's really the objective of the administration? Is it, are these things leverage points that they'll use in a negotiation to reduce trade barriers with other countries? Or is the goal, a de facto movement of manufacturing back in the US? And I think that's the question that the markets are sort of contending with.
Yeah. No question. I think my view is it's a principle of President Trump to bring manufacturing back here as part of his Make America Great Again. That said, I think he's very willing to negotiate on tariffs. I mean, his most recent statement was quite amazing, just as much as he almost precipitated a downturn in February by saying he'd be uncompromising. Now, just a few days ago, he said 20 to 50% okay, which is good news. I mean, I think the world can live with 20% higher tariffs from the US.
It's funny, if you go back even to the 1980s, I think 87, 88, Trump had, remember, taken out those full page ads in the New York Times and the Washington Post talking about how politicians have been taken for a ride, like you mentioned, by other countries. And so this is a long-term thought that, that President Trump back then, real estate developer Trump had. And so I think this is something that's almost become entrenched. So the idea of balancing trade amongst trading partners has become, as an important thing. And now he sort of has the leverage to, enforce a more level playing field. So let's see.
I'm old enough to remember those ads.
Do you? Yeah.
I remember one which he took out where he said that Japan is sucking the blood out of the US economy.
Yeah.
And that was just before the 1987 Plaza Accords.
Right. Which, didn't he own the plaza at that point?
He probably did.
Yeah, go ahead.
Oh, I was just going to say, both of you have provided a lot of examples, historical context when it comes to trade, tariffs, supply chains. But I'm going to kind of put both of you on the spotlight, Dr. Zani, first. What are you and your family members buying now, and what are you waiting to buy?
So what we are buying now is we're trying to be very cautious in how we're looking at things. So, major capital expenditures are off the table. Not that at my stage of life I need to invest in major capital items, but I'm talking of the family at large. Me, my wife, my kids, grandkids, and so on. I think broadly speaking, atmosphere of some caution. At the same time, recognizing that if these tariff regimes go through, cars would become very expensive, for example. But what we are deferring buying, personally, as I was mentioned earlier, I'm deferring my haircuts for a while, so that it won't make any difference. But more seriously speaking, I think it's pretty important for people to be now much more aware of what the situation is. In the past, there was some confidence that the economy would always recover quickly, and so being ignorant didn't matter so much. We could focus on our profession and go with it and hope that the rest of the system would follow along. And we were confident in that. We were confident in our education system, in our civil system, and so on. That, I think, is where you now need much more education. The Jamaat has to say, we're going to want to take more responsibility for understanding our situation. I mean, obvious example would be how many jobs are dependent on Chinese exports to the US. The calculations are well over 300,000, and some estimates go up as high as 5 million. So that's even if it's only 300,000, that's the low end estimate. What this means is that cutting off exports from China till the system adjusts, and maybe my thinks it'll adjust very quickly. My sense is these things take 2 to 3 years at least. You're going to see 300,000 jobs at stake. That's not a small amount. So we have to understand that if you're in those businesses which are affected by those jobs either directly or indirectly, that's a big problem.
So I guess I'll answer your question second. So I just wanted to maybe respond to Chairman Dasani's comment. I think I'm a little bit more optimistic in that I don't think that the economic adjustment will happen as quickly to 120% tariffs. I certainly think that would take time. And like you said, tow trucks won't be made in the US overnight or anytime soon. I do think, however, that, unlike prior, sort of economic challenges or uncertainties, call it COVID, call it the '08 crisis, even in 22, the inflationary, sort of responses that the economy had to deal with, this is entirely sort of a man-made nature. And no question, lasting long enough, it may do some marginal economic damage. However, remember, the worse this gets, the more pressure there is on the administration to go the other way. So I think that there is a real possibility that that things, now they may not never go to zero, but I don't know that they stay at 125%. And every action we've seen by the administration after April 9th has been conciliatory, whether he loosened restrictions on certain goods, whether he reduced the tariffs on certain countries, whether he said he was talking to China. Every action has shown a willingness to deal and get something done. And again, if any president is a deal maker, it's a guy who wrote the book Art of the Deal. So I don't think this stays the way it is for the next year and a half. But again, we don't know that for sure. And again, we have to prepare. So I guess my point is, I think that, in terms of purchases for my family, one thing we're buying vacations. Historically, the US dollar has been strong against other currencies. So that was an easier thing to do. Now, I think it's been more difficult with the dollar decline. And so, you're thinking about sort of how best to spend. Do you do a staycation or do you go sort of elsewhere? In terms of buying a car, a lot of these things are sort of, if you can, if your car is breaking down, you need another car. The economic cost to you of not having a car is far greater than the 20% delta or 15% delta off of the car that you're thinking of buying. So you might downgrade cars or maybe not get the extra premium features, but I don't know that you can push off an important purchase like that for too long. Again, unemployment is low. And while, again, like Chairman Dasani said, maybe 300,000 jobs are linked to China, those jobs don't all go away, right? That's on the margin that the impact happens. So again, with a 4%, 4.5% unemployment, and we saw kind of where real incomes are, it's not terrible. And I think people, if you look at consumer spending has stayed very strong. Consumer balance sheets, while they are continuing to lever, the default rates on credit cards are normalizing. They're not at all in excess. I think the one point of concern that I've seen is that people are paying at a higher level their minimum payments on credit cards versus making sort of the full payment or higher payments. So that's maybe the one cause of concern. So again, I don't see kind of I think people maybe on the margin spend a little bit less or take fewer options or spend less on luxury. but I think that it's all in the margin. It's not as disastrous. You saw it from Chipotle, the example, for example, so that their recent earnings, they mentioned that the comps were 0 to 1%, right? They didn't grow very much, and the response of the company was to not increase prices. So you'll see, again, the companies, you saw the auto companies as they announced, pre-tariff sales, and so I think you'll see a response both from the manufacturers and the producers, but also from consumers, and it'll be, I think, a lot less than potentially, it sounds scarier than it, I think, will likely be. Hopefully that answered your question, Saad.
It did. And actually, both of your responses touched on labor and employment. I kind of want to shift the conversation there a little bit, if that's okay. So we know that the U.S. unemployment rate is around 4.2%. And overall, the labor market, generally speaking, remains pretty solid. Dr. Dosani, what are your thoughts on current labor market conditions?
No, undoubtedly, it's been a pretty good situation that I think we should also give some credit to the Federal Reserve Bank for its policies on making sure that as they calibrated the interest rate with inflation, they were not overlooking the employment situation. So they did it in a nice way. Again, the problem is, abrupt changes cause large effects. And that is where we don't know. If you look at it's really from mid-February onwards that we are seeing negative occurrences. For example, in the job market, I mean, it's clear that hiring is falling at a precipitous rate in many industries, from what I'm hearing. I more closely track the education sector, and I'm finding quite a significant shift in graduate application rates. It's going up as people are losing jobs. So my view is that mid-February to now, it's only about 2 months. We don't really know. The data hasn't yet come in, and we don't have very good advanced indicators. So this is the problem, and maybe that's why with the same data, I can be more pessimistic, Mayur can be more optimistic. But I mean, the result is that my view is that we'll find out in the next 2 or 3 weeks when the actual first quarter data comes out, which will capture about half the quarter in terms of abrupt changes. Because what we've seen is an unprecedented level of change. I mean, close down this department, that department, US aid, and so on. These are bound to have effects that are going to be significant, in my opinion.
Why? I mean, the employment there is very low. They're not huge spenders in the U.S. economy. Why do you think that they will have impact?
Which employment is low? Education?
No, sorry, I meant departments of the government, right? Government departments shutting down. They're not necessarily huge. Yeah, go ahead.
No, not directly, but the Department of Education supports a huge number of research projects, through its IED, International Education, not international. I forget what the anagram stands for, but the IED is a major funder of education research in the US, which has made the US the #1 country in education in the world for so many years. Now, all that will go. So their funding going affects the research projects of thousands and thousands of universities. So it's much, much more than just the direct employment. People are laying off graduate students, PhD students who are otherwise getting funding for their research. So these are some of them. I mean, one can obviously, we'll have different effects in different kinds of departments, but that's significant.
I think what's important to think about in the labor market is actually the reduction in labor supply. With the other initiatives that the Trump administration is taking with respect to immigration, there's been a dulling effect on the willingness to participate in the labor market. So, do you have people who are here illegally, who are participating in the labor market, no longer participating because they're either no longer here or because they're nervous? But you also have, potential green card and visa holders who are not going out and working because of the fear of being caught up in all of this, whether they're here legally or illegally. It's funny, I've been speaking to several Jamaati business owners who are telling me that their C-stores are slower because people aren't out, immigrants aren't out buying, in those stores. I've heard from other business owners outside of our community, of course, that bars and restaurants are slower because you have less of that, sort of immigrants or people who are scared of what's likely to happen, consume less. So it's actually having an impact on the demand side, which is surprising. But again, even the supply of labor coming down will have an impact of increasing costs for companies generally.
Right. So what you're saying is revenues are down and costs are increasing. That's not good news, right?
It's not, but I think the margins are able to be handled. Like, I mean, again, I think that, the reduction, the increase in costs for labor has been going on for a while. So we saw during the Biden administration, the continued increase in minimum wage. I know that in my area, in New York and New Jersey, that's $16, where just across the river in Pennsylvania, it's $7.50. Now there are businesses that are competing in the same market. Philadelphia and Southern New Jersey are effectively the same market. And the impact, you can't sell a good for 15% more in the same market, and so the impact is being felt on the margin, right? On the labor costs, labor share of income is going up. The share of income for equity or ownership is going down. So again, and as you know, I mean, the gross margins of corporations have been at their peaks coming into 2025. So if some of that gets impacted, I think capital versus labor takes the hit initially.
Well, what I don't want is my PhD students doing convenience store work because they can't find anything else.
They may get paid more doing convenience store work. I know how badly academia pays.
That's true.
So just to kind of address a point you made, Mayur, on just immigration policy and kind of the example you mentioned of the conversations you've been having, do you see this varying state by state, or do you see this happening more broadly across the U.S.?
I'm sorry, say that. Which part of it? The immigration enforcement?
Yeah, just the impact that immigration policies had. For example, in those C-store owners, they're already starting to see, kind of a pullback in consumption in their area.
I do think that's a short-term impact. I mean, again, there was a lot of fear of ICE raids and so forth. I think that's ameliorated to some degree. I hope it has, and it's a good thing if it has. I think that'll continue declining as, I think the administration was after some headlines, it got them, and I think now it'll hopefully normalize, inshallah. What I will say is that I think the state-by-state impact has been more statutory based on minimum wage and other labor costs. So I think in California, Dr. Hassan, you may know this better than I do, but from one of the companies that we work with, it used to be 40 hours a week, above which one gets minimum double time and a half for overtime, and now it's 8 hours a day. So you can't shift that labor as effectively or as flexibly as you once wanted to. If someone works 9 hours a day, that ninth hour, that last hour gets paid time and a half. And so any of those restrictions, any of those inflexibilities in the labor market by state will have an impact on the businesses margins. And so businesses have the ability to shift very quickly. Again, I was talking about New Jersey, Southern New Jersey, and Pennsylvania and Philadelphia. Those are, unless you have a plant that's fixed and you can't move it, the marginal dollar will go to the lower cost geography. So I think states compete with each other just like you have countries competing with each other with tariffs. Mm-hmm. States also have that internal competition. Again, I'm not sure if I answered that question, but again, state by state, it's more a function of, I think, statute than it is immigration.
You did, and kind of just staying on the topic of both business and their sort of use of labor, but also importance of consumption and labor market impacts that they have on their own respective business. We have heard of federal policy cuts, federal job cuts, and then a move from public sector to private sector. What kind of opportunities do those provide to businesses in areas that we have seen that impact happen?
Look, I think, again, this adjustment, I think Dr. Sani has a very well described discussion around changes, when happening abruptly,
Mhm.
can cause breaks, right? So I think these changes have also happened very abruptly. And so we haven't seen the kind of allocation of that labor into the private market. Again, my personal view is as that labor does get redistributed to the private markets, those private markets are much more productive user of that labor than government. And that's not sort of a blanket statement. I mean, some parts of government are very effective users of labor. I think, the FDA, other kind of departments have typically been, for the dollar of labor dollar spent, very productive in their returns to the U.S. economy generally. But others have not, and particularly when you have departments that are sending dollars elsewhere. I'm not saying they're not good for the long-term health of the country, but in terms of GDP productivity, by sending dollars overseas for aid, that's really not, benefiting our GDP as much as it would. So that labor dollar, in the private in the industry potentially produces a higher return in terms of GDP.
Yeah,
Tell me if I'm
well, on money going overseas, much of that comes back, right? Because it's tied aid. About 85% of US aid to other countries is tied. You can only spend that money in buying American goods and products. And so, it has much, much less of an effect. It's not lost money in any case. The other part I think we should be, cognizant of is that if you close down for example, look at international relations. If you reduce the size of the State Department without any good calculation, I mean, the way the tariffs were calculated, taking the deficit and dividing it by the total trade, completely irrational method. Till today, they have not been able to justify it. The same thing, if you cut down the State Department, which has been one of the, carefully thought out, I think, initiatives of the US government, you're actually cutting your long-term, cutting your sort of your whatever that thing is to spite your nose to
despite
spite
your
your
face.
tail.
Yeah.
Yeah. But I don't know. I mean, I'm not going to insist on it. I think more work needs to be done. But there is a certain equilibrium that was created over many years where these things coexisted. You had people, very dedicated to service, joining the Peace Corps, joining diplomatic corps. I work with several over here, and they are devastated, because you can't move from being a diplomat to being something in the private sector, managing inventory or whatever.
Yeah.
So it's a complex situation.
I mean, but again, if you think about the kind of the Midwestern, factory worker, right? We've asked him to sort of, or her to reskill out of that, and that it's tough overall. It's funny because we think about the implication of reskilling on higher, sort of white collar jobs or higher intellectual jobs, and for the longest time we've seen the impact of technology or policy change. For kind of the lower level workers. And now for the first time, whether it's because of changes in federal spending, state spending, or even now AI, you're going to see an impact on sort of higher level work. And it'll be interesting because I don't think we've seen that in the past.
I went to get this book. This very interesting book Farrah Stockton has written called
Okay.
American Made. She's a reporter for the New York Times.
Uh-huh.
Although I think she recently left them and joined the Boston Globe. But she points out, this is a visit going through Middle America, the Rust Belt, the kind who voted out overwhelmingly for Trump. And what she found is this stagnancy. People don't just leave when when a town that has a steel mill goes out of business. It takes many, many years
Exactly. Yeah.
to
Yeah.
move out. It takes
If it
generations.
ever happens, right? Yeah.
Yeah, so adjusting at the margin is really hard. It takes time. I mean,
No, I
it
think we're
calls
making the
for a
same point.
resiliency of the US economy that may or may not exist.
Yeah, and I think this is something I've read recently that talks about whereas prior administrations had focused on mean incomes, I think the Trump administration is focusing on median incomes, which is interesting because you think about that it's not the overall level of GDP that matters, it's the GDP per capita for that median worker. And to your point, because that transition has been challenging and arduous, I think that voter votes for Trump, and Trump is now thinking about that worker more than potentially has been in the past. And I guess the point I was making was while that's impacted the blue collar worker historically, for the first time, I think we're going to see those impacts on white collar workers. And the adjustment factor there will be just as arduous potentially. I hope less arduous, but potentially just as arduous.
Yeah, that opens up a whole new area of problems for the US. The US is a champion at exporting services. Right? We do $1 trillion worth of services, completely below the radar screen because it's services you often can't even measure it that easily because it's a bank to bank transaction or something. What happens if the trade war goes into services? Or if Microsoft has to pay a tariff every time it wants to sell a system in China? I mean, that's going to be devastating for the service sector. But let's hope it doesn't get to that point.
Yeah. One final question I actually have for you, Dr. Dosani, before we move to our next topic is, when thinking about recent college graduates, what recommendations could you provide to help them navigate the current labor market?
So college graduates today, you're talking of those who have a career already sort of planned in mind, right? We're thinking about, or you're just thinking of undergrads planning ahead.
Yeah, let's say maybe undergrads planning
Okay.
ahead.
Yeah. No, so that's a really, I think, important question from the point of view of planning because, again, the traditional, a traditional way of thinking about college education was that you went to the best university possible and started thinking about your major, so you graduated with some expertise but not quite enough to make a career out of it. Then you got some job experience and then you finally chose a career out of that and specialized a bit with some more education and took a job, right? So that was the historical trajectory of how one thought of an undergraduate education. I think now things are changing. One is, of course, previous Imam Hazrat Imam Shah Karim had told us that we will each have many more careers than people had in earlier times. From one career, you might have many as 3, 5, 7. He said also once, and I think that's being borne out more and more. So and it reflects the changing times where you need a lot of flexibility and nimbleness, and the focus should be on getting a good conceptual education and thinking much less about career too early in the game. I would say that's why I like liberal arts schools. I think they prepare your mind really well, and you can then do specialize quite easily. So for a college graduate who's in the early stages, of thinking about a career, I would say focus on getting as difficult an education as possible. Challenge yourself to don't take a pottery class where you can't fail unless you break the kiln. Take a class where you learn math, you learn symbols, you learn symbolic work is what you have to look for. So that's what I would advise.
No, thank you. Thank you for that advice.
Shall I jump in with
sorry, go ahead.
No, I was going to say I was going to give my thoughts there, if it's okay.
Yeah, absolutely.
I think what my recommendation would be is to, if you're graduating and the economic situation is challenging, I know for several people, particularly in some technology industries and government and so forth, it has become more and more challenging. I think my recommendation would be get a job. Don't expect, if you don't get the job that you were expecting, and there's another job that's out there, take it, because the experience that you'll get in working will pay back, dividends for many, many years. So not just kind of the people that you get to meet, the skills that you acquire, like Hazrat, like Shakarim and Chairman Dasani both said, this won't be your last job. But the skills that you get from this job, the people that you meet, the ability to work and sort of bring together different ideas, the evolution of markets that you'll experience, I think will be incredibly helpful in your future careers. So rather than kind of sit at home and sulk because you couldn't find the job that you wanted, or go back and double down on extending your education by another year or two, there's an opportunity cost there, but there's also a financial cost there. School will be there. I think that there's nothing, going wrong with getting a graduate degree. I think it's a wonderful thing, but I think there is something to be said about work experience, particularly as the economy is changing. By being in it, you can be an agent of that change and a beneficiary of that change versus a victim of the change.
No, certainly something to be said for that. Yeah, getting real life experience never hurts. You just don't want it to overwhelm your life and make it your career that way, right?
Again, but I think that's right. I mean, don't worry about this job being your career. Is my point. Your career will find you. You will find your career. Get out there, start working, start getting involved in things, and that interaction, I think, will help you synthesize the thing that you want to be doing or that you should be your career.
Could go either way. Yeah, I agree with you. Could happen.
Yeah, it's great advice. Honestly, without giving away my age, I'm mid-career, but I feel like I can even take snippets of both of your advice into what I want to do for my third, fourth, fifth career as well. Mayur, I'm going to kind of stick to you here for a second. So the Federal Reserve has held interest rates steady since December 2024. And as recently as March 20th, Chairman Jerome Powell has said he is in no hurry to cut interest rates given the inflation remaining above its 2% target. He has also indicated that the Fed will take a data-dependent wait and see approach for monetary policy. But we do know earlier this week, two members of the governing board of the Federal Reserve Bank have said that they do expect a rate cut as early as June. What's going on, and where do you see rates going from now over the next 12 months?
Look, I mean, my opinion is just as good as anybody else's, which is, completely useless. But I'll tell you what the market's sort of saying, right? The market has the 6-month rate at, what is it, 4.3%. The federal funds rate is now again, the target between 425, 450, which is telling you that for the next 6 months, the market at least doesn't believe that there's going to be a cut. My personal view is there's probably one cut in this year. The prediction markets are saying 2 to 3 cuts. Look, I guess it doesn't really matter whether there's a 25 basis point cut or a 50 basis point cut, or at the end of the day, the question is, will rates remain somewhat elevated? And I think that they will. I don't think anyone thinks rates are going down by 2% points, right? We're not going to go from 4.5 to 2.5. We're going to go from 4.5 to 4, maybe 3.75. And so, and that's just the short-term rates, right? The real rates, I think, that matter for our lives is the 10-year rate, which, today is, 4.35 or something. It's funny, there's this James Carville, the political director for Bill Clinton, said, when I die, I thought I wanted to come back as a baseball player or as the Pope or as a president, but now I want to come back as the bond market because you can intimidate anybody. And I think what's interesting about that is, when you saw Trump really finally relent when, the 30-year bond yield hit 5%. And the reason that matters so much is because that treasury rate has an impact on the full financing mechanism for the United States, right? So whether that's mortgages, whether that's, corporate borrowing, whether that's, the people who are listening, their bank rates, right? The prime rate is driven off of the risk-free rate. And so, I guess my point is, whether it's 1 or 2 cuts, I think we all have to prepare our financial structure so that we are living with rates above 3.5%. And again, to your point, the Fed is taking a wait and see approach because, again, either the tariffs are inflationary. Now, again, let's maybe step back. Why does the Fed even do this, right? The Fed has, what we call a dual mandate. The first job is to make sure that there's full employment, right? Unemployment stays low. And the second job is to make sure that there's price stability. There's not too much inflation or deflation. Their target is 2%. Costs increases every year, or prices increases every year. Right now, there's a market term. There's a way to look at projected inflation called the 5-year forward, which is what does the market believe inflation will be in 5 years for the next 5-year period. So from 2030 to 2035, and that's still very low. It's 2.5%, 2.6%. So there's not an expectation of huge inflationary pressures, which is why I don't think the Fed is certainly going to raise rates. I think they're waiting to see how these tariffs and the policy changes will impact employment. And if they think employment will get impacted negatively, they can cut rates to stimulate demand, stimulate economic expansion. So I do think it's going to be a wait and see approach. I do think they're going to cut maybe once this year, maybe twice. At the end of the day, I think that's more of an academic discussion. I think what really matters to people is to believe in your head that rates at least the risk-free rate will stay at 3.5 to 4%, and you have to think about your cost of financing, whether it's credit cards, mortgages, businesses, maybe being coming down by 50 basis, but 0.5%, but not a lot more than that.
If the real interest rate stays at what you're saying, Mayur, is that inflation will be around 2%, right? What it is right now.
2.5%, yeah.
2.5%. And then you have, you have a nominal rate of 3.5%, 4%. So you really have a real rate of 1.5% to 2%.
That's right.
Now, the productivity of the US economy is not growing at that rate. So it's not sustainable. You have to be able to bring inflation down to below, to 2% or less. And at the same time, bring real rates down as well to something like below 3% if you're really going to have a sustainable productivity growth. And we know that Trump's tariffs will actually hurt productivity in the short run, right? Sorry, just to quickly finish.
Oh, yeah, sorry.
Is that
you just said real rates, but below 3%. I think you meant 1.5%, right?
Yes, well, 1.5%.
Yeah.
Sorry.
No, that's okay.
The point is that if two governors or two members of the Federal Reserve Bank have broken with what Powell said a month ago, wait and see. It's all engineered. I don't think Powell is saying something and then these people are saying things to contradict him. What they're saying is, we are seeing in the last month and a half some dramatic changes that need to be considered. That's what my interpretation of it.
It's ironic that I think the more the president tries to jawbone the Fed into reducing rates, I think it actually is quite counterproductive. I know all the parents in the audience will understand this, but the best way for me to get my daughter to not wear a skirt ever again is to say that I like that skirt. And if I ever tell her I don't like the skirt, she's going to wear it tomorrow. So I think it's not dissimilar with Chairman Powell, which is they want to be seen as being shielded from political pressure. And the more the president tries to jawbone him into cutting rates, I think it's actually harder for him to do that than it would ordinarily have been.
Well, hopefully at least one of them is mature. It's not that. But in terms of clarity, I think broadly, Mayur, what you and I are both saying is that there is uncertainty. The direction of interest rates might take a certain trajectory, 3.5%, 4% or something less. But the reality is that people should still become aware of the situation and plan accordingly.
Exactly. Yeah.
Right.
And don't hope, I think, for rates getting back to where they once were. I think that's something that I personally, can't do. And
let's say that we don't 100% agree on that, but I think the need for planning and being aware of how rates are going, I think there's no substitute for that. I mean, similarly with undergraduate education, we didn't quite agree on whether you should take a job, any job, and just get going. I mean, when I thought of that, I was thinking of my students working as they do, some of them as waiters and hoping to be seen by some Hollywood star in LA, but where I live. But, I think, again, good planning, being aware of your situation, of your particular characteristics, and then saying, so the real message that I think we both agree on is the importance of planning, right?
Absolutely. Yeah. And maybe, potentially planning for the downside. And, if the upside comes, wonderful. If rates come back down to, 1.5%, then you can always refinance your mortgage or you can always refinance your debt. And I think, again, the US financial system has this wonderful, sort of put option that they've given, borrowers, whether it's for mortgages or bank loans or credit cards. If rates go up, you can keep, your mortgage where it is if you have a fixed rate. If it goes down, you can potentially refinance, which is a really nice free option that you're being given, or a very cheap option that you've been given as a borrower.
Agree. Yeah.
So I love how both of you are making my job very easy. Both of you mentioned planning accordingly, and there's two factors of this. And Mayur, I'll talk to you first on businesses, and then Dr. Dosani, I'll talk to you about consumers. So first on businesses, planning accordingly. How should businesses and even investors think about the current financial conditions and current financial situation, at least as it relates to monetary policy, interest rates, when it comes to investing in other businesses, making acquisitions, and even launching startups?
The last one, I think, is, you never want to sort of, take away from, someone sort of having a great idea and pursuing it. However, if you think about the probability of success, funding is such a key element of startup culture and sort of successes in early businesses. I think that funding has gotten, if not dried up, then it's gotten particularly onerous to get at. If you think about sort of the expectation of return, it's gotten much shorter. The duration requirements for return have gotten shorter than longer, with rates where they are. So I think if you have a great idea and you think you can make it work, wonderful. But I think the it's a higher hurdle. In terms of businesses, you're asking about how they should plan for kind of with this economy.
Yeah.
I would say look, you want to be a bit more cautious than you once were. But again, I don't want to sort of I don't want to recommend extreme caution. I think with every situation, with every market, in any volatile environment, look, volatility increases the value of options, which means that you don't want to sort of spend vigorously. You don't want to sort of take actions immediately. You want to sort of evaluate your options. But that doesn't mean that you shouldn't sort of spend when you think the time is right. So if you can expand, and because of the volatility, the price of the neighboring sort of warehouse has gone lower. Again, COVID, if you look back at prior times, in 22, when inflation was running rampant at 6.5%, 7%, during COVID, when you didn't know when the government, sort of when the disease would get solved, in 08, when it's a balance sheet restructuring and effectively the entire financial system was kind of seizing up, this doesn't seem like it's as bad as prior economic downturns. And so, will there be pain on the margin? Of course, right? And you don't know how that pain is felt amongst different industries. However, you're the best evaluator of your business. I wouldn't be in a bunker scared that things are going to go down a cliff like they did in 08. Even then we survived, right? So I think to the extent that you can be cautious about your investing, if you see a real possibility of return, if you have customers that you can, sort of fill the warehouse with goods and you have customer demand for it, potentially this volatility gives you opportunity to invest at a more attractive level.
Yeah. So on that, I think that COVID showed that those who were well prepared for digitization, who'd, spend effort on creating platforms and so on, benefited much more than those that hadn't. And there were windfall gains to be had by that sort of thinking, that there are some underlying trends in an economy that are not going to change. But certain cataclysmic events can accelerate the progress and give you a completely different position. I think likewise, I think the real issue here is how systemic, how much will this administration's attitude towards how business should be run, how government should be run, how will that affect the system itself? Is it shaking up the system as people that I talk to in education feel? Has no effect on system as people I talk to in Silicon Valley feel, where they're still able to get their money and startups are being of that kind, at least still being well funded? Or is it something that we'll work through? There'll be a temporary shock, which seems to be, Mayur, your position is closest to that. I think the jury is still out. I'm not willing to commit to either one. And once again, I would say the need for thinking about these things, becoming well educated. I think the one message that I'm getting out of all these changes is we need to really be able to apply our minds, and there's no excuse for ignorance anymore. And you had a question about consumer?
Yeah. So still under the lens of planning accordingly, what should households and individuals really keep in mind when thinking about their current financial health and planning accordingly as we move forward?
But actually, they face a difficult choice, because you have people who have budgets that they need to meet. They also have some savings that they need to invest wisely, and it's many people say, "Oh, diversify." So you put some of your savings and give it to a professional advisor, and he or she will diversify your portfolio for you. But it's not clear again what is the optimal strategy. Even going to financial advice, most of them were wrong in the 2007 crisis in predicting what should be done. And Warren Buffett has a nice saying that diversification is protection against ignorance, and makes little sense for those who know what they are doing. So if one only looked at the first part of what he said, one would say it's a good thing to diversify. But if you're ignorant about something, diversify away. But what he's really saying is that if you know what you're doing, don't diversify. In other words, if you're well educated about something, and you can never be as well educated in everything, you have to pick your targets carefully. And then you can diversify away whatever little ignorance you have. So, I mean, if Mayur comes up with some very fancy structured product, which might be great for those who understand it well, for those who don't understand it well, it might actually pose more risk because there will be changes.
I think that's so important. I think, and to quote, to Warren Buffett some more, he calls it his circle of competence, right? If it's within your circle of competence, meaning for the people listening today, if you're running, a C-store with a gas station, your circle of competence is very specific. If in that circle of competence you see the opportunities, I think to maybe I hope I'm not putting words in your mouth, Dr. Sani, but in that circle of competence, you don't necessarily need to diversify away too much. You can take a bet in the area in which you're an expert. If you're a C-store expert and you want to buy real estate development, maybe think twice or have a bit more caution there, especially in a volatile environment.
Yeah. That example of real estate is really important because this happens, right? In the Jamaat, we have several people. I've spoken several, both when I was actively involved and now, who come to me and say, I don't know anything about real estate. I'm very interested in it because people have made so much money. There are experts in the Jamaat out there who are running funds, willing to take my money. But since I don't know anything, should I do it and trust that person? And my response to them is, well, twofold. One is I said, don't ever invest anything that the Jamaat is offering, simply because, if things go bad, can you leave with your head held high? Hazrat Imam, previous Imam, always would tell us, if you get into any contract, leave with your head held high. It's very difficult to do if you're dealing with someone who's your friend or your relative or within your community. But, not everyone will agree with that, I understand. But to the second point, going into something that you know nothing about, I think is high risk. And it's very important to understand how much of that high risk you can take. It should be a very small portion of your assets, not a large portion.
And so and Dr. Sani, just to kind of wrap up the question on consumers and households when it comes to planning, what do individuals and even retirees that are on a fixed income, what are the things that they need to really keep in mind in this current environment?
Yeah, for retirees, I mean, one could argue from looking back a year's perspective, that they put their money in very safe money market instruments. They wouldn't do that badly. I mean, as the default risk of investing in risky investments has to be very carefully looked at to see if it really makes sense or not. It doesn't in all cases. I would say again that reiterate the point that retirees have fixed incomes coming in, and they have some, maybe from their pension or their social security. They have to be able to manage their expenses within that. Not look at unless they, if they're going to rely on returns from their portfolio investment, then they have to make sure that the safety level is met. If a month back, if somebody had 100% of his savings as a retiree in equities, they would really be quite upset now. So it needs to be very carefully done. So one thing, I think the message would be well educated and only take risks that you know about. Don't take risks that are unknown risks. Take known risks.
And in this current environment, do you see any sort of changes or expectations on changes of retiree benefits like Social Security at all?
Well, it's linked to the inflation rate. I don't think any administration that I can see in the next several years is going to tamper with the formula too much. At most, if there's a lot of groundswell against that America can't afford it, they might change the retirement age by a year
Or the
two.
income level, potentially, right?
Sorry?
Or the income level at which.
Or the income level at which it has. Yeah, that's also going to be more difficult politically, I think.
Yeah.
But yeah, I think question is whether that's, Social Security is not what everybody relies on. There's also Medicare, Medicaid, and so those could go through much more significant changes, particularly Medicaid. So I think that's a worry that retirees have to be concerned about. I'm not sure what they can do about it.
I think maybe to that I would answer that there are to Chairman Dasani's point, there are one needs to be educated. So please let's start with that. But I think there are more products for retail investors now than there have been in the past that are accessible. So historically, accessing bond markets, accessing things like private credit, and accessing I think Dr. Dasani meant structured products. Again, these all have various levels of risk and return. However, there are more opportunities to invest in those things by retail investors than there ever had been before. It used to be only institutional investors had access to these products. Through the advent of ETFs, through the advent of wealth managers offering some more of these platforms from alternative investors, hedge funds and private equity funds and so forth, one has access to things that they didn't once prior have access to. Again, they're not all wonderful, so some carry significant risk, but I think at least the more arrows you have in your quiver, the more likely it is you can hit the bullseye. And so I think it just allows the investor to think more broadly about their risk allocation. It used to be just equities, maybe treasury bonds, and maybe real estate. And now I think you have a full spectrum of investment opportunities that I think are much more easily accessible and understandable.
Yeah, that's a great point. Thinking about globalizing, people who are mid-career professionals, who I think should really think about how do they take advantage of global trends. As the economy here sort of readjusts and becomes a little more insular from the rest of the world is not stopping; it's moving on. So, for example, if you look at say privacy rules, so in healthcare and various fields of education, various fields of data where data is used for services such as in healthcare, in IT, in pharmaceuticals and so on. Privacy rules which protect the rights of the individual as a patient or as a client of a financial firm are becoming very, very important to observe. And this is a new field for most of the world. The US actually has much more experience. So we actually can bring to those kinds of fields a level of expertise that could be extremely valuable and rewarding. So, I think there are opportunities globally which may not be available within the US for the time being that we should look at.
Yeah, and when we talked about the investment landscape, just another part of a market that's very important is real estate, both for businesses and households. Mayur, just briefly, any thoughts on where you see real estate going, both from a housing market standpoint or even a commercial real estate market standpoint?
I mean, I really don't, and anything I say you should very quickly discount. But I'll give you my opinion anyway, since you asked. Look, when you saw a decline in rates, you didn't see a massive uptick in mortgage applications. Several, again, because of affordability issues that Dr. Dasani referred to before. People are having a hard time accessing housing. The price of housing has gone up. There are people who are, in a good way, stuck in their houses because they have very low rate mortgages. And again, I think you said the average rate is 4.5%, which is actually very low historically. So bottom line is that we actually have this delta between kind of people who are stuck in their houses and people who want to buy, and there's no transaction values have fallen, volumes have fallen, but values haven't adjusted. So again, I don't know if residential real estate will be kind of a great option. Or again, if you have to buy a house, you buy a house. But I don't know that you'll find a great deal. In terms of commercial real estate, there has been actually a nice demand from industry, warehouses, logistics, data centers. You've seen a massive demand in commercial real estate. Obviously, office space is less attractive, although that's even making a rebound. But I think there has to be an adjustment factor. If you look at sort of old real estate that hasn't been productive, like malls, versus new real estate that is very productive, like warehouses, there's just a delta between kind of bid ask on per square foot. So, warehouses, you're maybe willing to pay $10 a square foot, whereas retail, was asking $40 a square foot. That difference, needs to be bridged before more real estate transactions can happen, at least in the commercial sector. So I hope that gives you some perspective, but I'm not sure it's terribly prescriptive.
It does. And so just want to say thank you so much for being here, Dr. Lasani and Mayor, and for your time. I know the audience here can really appreciate the insights you've provided on today's topic. Before I open it up to Q&A, I do want to kind of make sure everyone is aware of all of the offerings and services that the Aga Khan Economic Planning Board provides. These resources can be found on this slide. It's a great reference. Including IPN, which is focused on connecting us with each other, assisting with career and professional development, and providing resources and skill development. IPN, of course, offers a number of programs and services to the community, which allows us to build on top of what we've learned today, such as job placement, as well as entrepreneurship. And so please definitely reach out to IPN if you have any questions. But of course, this is a fantastic resource slide that is definitely really beneficial. And I know I definitely use it a lot. For the audience, we will be sending out a follow-up email on Monday. The email will contain the link for today's webinar recording, contents of the resources slide with various demand services links and a survey link. The survey allows us to learn from the audience on how we did today and how we can continue to improve for the future. Your feedback is invaluable to us, so please just take a few minutes to let us know your thoughts. And with that, I will open it up to questions from the Jamaat. So the first question is going back to our conversations around tariffs. What is non-tariff walls in Korea and Japan?
Or non-tariff barriers.
Barriers.
Yeah, walls, WALLS, not war.
Yes, walls, as in like the walls
Yeah,
of a room. Yes.
Yeah, so non-tariff barriers include things like, if retailers have within their own community of, say, Japanese retailers have an arrangement that they will together not carry showcase American cars. Or if they do, they don't give it enough space, or, shelf space of a product in a retail store. All these are examples at the industry level. Then there are non-tariff barriers that governments put up, for example, excessive inspection of products when they come in. I'll give you one example from South Asia that Nepal is a country that sits to the north of India, and it has open borders as far as labor is concerned. So there's a large population of Nepalese who live and work in Delhi, which is on the sort of the western side of the country. And so there's a brand of tea that the Nepalese like that they want to sell to the Nepalese the migrants out there. But the Indian government, to make it very difficult for that tea to reach them, to keep their own tea competitive, requires that tea to go to Calcutta, which is 600 miles the other way, to be first inspected. And each crate has to be inspected, and then it's allowed to go to Delhi. So that's a perfect example of a non-tariff barrier where the government makes it very difficult. A lot of research has been done on how much this is worth in terms of the cost, and the estimates go up as high as 30% on average, So that's significant. That's like a tariff wall of 30%, but implemented through a non-tariff barrier.
There's also potentially good non-tariff barriers, for example, regulation on sort of health standards, right? Or employment standards. So again, I know that there's non-tariff barriers that we have for importing goods from countries that use child or slave labor, or make sure that their health requirements are certain. So they go both ways.
That's not called a barrier, though. Yeah, I know what you mean, though.
And so, Dr. Lasani, how do you see this trade war playing out?
It's a good question because things are changing so fast. And my sense is, from what I can see today, there is considerable flexibility. on the part of the US government to get deals done. They were hoping that it would be like they would get the other countries except China on board to confront China on tariffs. That doesn't look like it's happening because, even just a couple of days ago, I was reading that Japan is welcoming all the Chinese electric vehicle makers to sell in China and sell in Japan and invest in Japan, because Japan has fallen so far back in EV technology that they need to learn from China. So my sense is that ganging up against China not going to happen, which then forces this government to be much more flexible. I see tariff probably ending up somewhere, not zero, but not more than 20%. But in that time between then and now is where the worry is. Yeah.
And so you mentioned tariff rates. What is the estimated effective tariff rate? Is it 145%?
Oh, what will it end up as?
Or where is it now?
Right now, it doesn't matter whether it's 65, 75, 85. It's just, that anything above 60%, the studies are showing it effectively closes down the trade completely for most items. So there's no trade can happen at this at the current tariff rates.
The overall average tariff rate across all countries is about 23.5%.
27, yeah. Oh,
23.5. Okay. So it's not the 145. Okay.
No, the 145 is just with China.
Just with China, yes. Yes.
Sorry, clarify that.
And
average, but that's still too high,
Yeah.
To put some math behind what Dr. Dosani is saying is exactly right. I mean, if you think about retailer margins, right, about 50% on a gross margin basis, in order to kind of, make up, or even if, let's say you have a 35%, 40% gross margin, you can increase your cost by 50%, 70% before your marginal cost goes to zero. And you still should trade because at least your fixed cost is being met. So you have some flexibility to keep going, but after 50, 60%, it just doesn't make sense to continue importing.
And so then thinking about a different aspect, the dollar, how worrisome is the weakening of the dollar? Mayur, I think you mentioned it earlier. And what does that mean for small businesses and consumers?
Well, weakening of a dollar is good for exports, right? So effectively a 10% devaluation of dollar is like a 10% tariff removed, right?
Okay.
So that's good news. I think there was some concern about whether the US was going to lose its status as a safe haven currency. And people know that there's really no alternative. The Chinese yuan is non-convertible, so that can't be a safe haven currency. The others are too small. That said, Europe has, again, free riding on the backs of the stable US currency for decades now. They've held all their reserves in US dollars. By doing that, they bought US dollars, increased the demand for dollars, kept the dollar high, and made it much more difficult for American companies to do business. So the hope is that, along with these changes in tariffs, some sort of negotiation can be done about how to manage the reserve currency structure as well. And if that happens, that's very good news for the US economy. But I don't see, under any circumstances, the dollar losing its status as a safe haven currency in the near future.
I couldn't agree more. I think that there's a lot of fear mongering around that. And the question you should always ask yourself is versus what? What else would there, there has been some, buying of gold from central banks, but honestly, the euro is the only other value. Swiss franc is only $1 trillion of value outstanding. There's just not enough of it to be a reserve currency.
So long term, of course, you're going to see that yuan become convertible, right? So the Chinese yuan they're just trying, I think right now they're worried that if they make it convertible, it'll be speculated against heavily. And they don't have the resources to push against that.
It's not so much the convertibility. It's not so much, I think, the convertibility. It's more a fear of, sort of what the Chinese government does with their currency. I mean, I know we've also been weaponizing our currency lately, but that's on the margin. I don't know if there's I don't know if there can be as much trust in the yuan as there is in the dollar eventually. Maybe it'll grow, but we'll see.
But isn't convertibility a big issue in the sense that,
It's the biggest issue, but I'm saying even if you get past convertibility, the fact is then what happens? Yeah.
Okay, got it.
Any also?
Yeah, so just another question. Before I ask a question, I know we are definitely at time. We do have just a few questions, so we will continue if you, Dr. Gosani and Mayur, are okay with that. We've got just a handful of questions left.
Of course.
Absolutely.
Perfect. Awesome. So, we've definitely heard in the news about executive orders. And with these executive orders being implemented, are there any sectors that you see that are going to thrive, whether it's like the travel industry, luxury goods, healthcare businesses? Where do you see opportunities?
Go ahead, Mayur.
I mean, certainly anything that supports a domestic supply chain. For example, we're working with a commercial laundry company, and all of a sudden, the local linen makers have become a lot more popular versus their Bangladeshi or Indian or Pakistani counterparts. And what's making them even more attractive is because you can incorporate an RFID tag into the sheets, and the laundry is now much more efficient because it's now using that function. Not only the sheets, on a relative basis, they cost less more than they once did versus the Indian and Pakistani counterparts. But now you actually have this benefit of additional technology, which is another 17 cents per sheet, which is usually $1.50, $2, which effectively makes your own plant more efficient. So I think the opportunities are certainly in local supply chains, wherein you can add an element of technology that wasn't necessarily available overseas. So that's just off the cuff one thing I've seen.
I think that manufacturing, the Jamaat has not really made great progress in manufacturing. They prefer to be in services. This is going to become important in the US. No matter what happens to the tariff structure, there will be something there that the government will put in to encourage domestic manufacturing, and with high-tech manufacturing, not necessarily low-tech, not making
high tech, but also things that are domestically important. We saw in COVID that you had even basic medical supplies that were not manufactured here. So things that are deemed national security, whether that's masks or scrubs for doctors that have microbial protection, that was all manufactured elsewhere. And now I think more and more of that will be done closer to home.
Shipbuilding will definitely become big. There are by the members of the Jamaat in India doing that. So I think there are lots of opportunities in house and services. Yeah, go ahead, Mayur.
So I think that raised a very good reminder that I think our Jamaat has an advantage in that we have a level of trust with others in other countries. And I think to the extent that we have these trade barriers that we're trying to sort of address, there are going to be winners and losers there. So while we might think China's a loser long term, there will be some ancillary benefit in India, potentially Pakistan, potentially other countries where our Jamaat lives. So to the extent that we can have trusted relationships and potential business opportunities with producers in countries that are deemed more favorable to the US, that can be an enormous opportunity that our Jamaat is very well positioned to benefit from that others may not be. And India is a prime example of that, I think.
That's a great point. And kind of still sticking to the theme of business sectors, given where we are and kind of just the broad range of economic sort of developments that we could see happening, how do you see the luxury goods sector and the hospitality sector kind of faring looking forward?
Go ahead.
I think luxury goods will, again, a lot of luxury goods spending came out of Asia, came out of sort of, and again, obviously the higher end spenders here. I think in the near term, everyone's going to be cautious. And so you've seen, the stock prices of LVMH and some of the other, sort of luxury producers, take a bit of a hit. I think they've all expressed caution. But I think long term, I don't know enough, so I don't want to be sort of they take a guess. But I think in the near term, there certainly has been cautious undertones from earnings guidances and from spending data for luxury items, both domestically but primarily from overseas.
Yeah, just a quick one on the hospitality sector. I just want to say that I think that's historically been very much linked to the local economy growth. So to the extent that where our Jamaat lives, which are in areas where manufacturing, I think, is going to become important. and the structure of the industry will change. And accordingly, the hospitality industry will have to cater more to regions or areas within a state where manufacturing will take place. Oil drilling, manufacturing, say, for example, in Texas. There's a big advantage, I think, will be there for those who can locate their services in those areas.
And you mentioned manufacturing. Even with AI, automation, robotics, how much manufacturing do you see coming on back into the U.S.? Is it not feasible to have all of it come back?
Well, certainly not all. Give an example of Taiwan Semiconductor Manufacturing Corporation. So they have a big arrangement with the US government going back to Biden's time, where they received $50 billion to set up a plant in Arizona. And they've done that. And now, under President Trump, they've committed a further $100 billion of investment in the US. So to put that in perspective, it sounds huge, but actually it's not that much of TSMC's asset base, maybe about 15%. So they still recognize that 85% has to stay in Taiwan, which is where they have their ecosystem is well developed. And by the way, a lot of that interacts with China. So they can't really move to the US and continue doing that. So I think may give you a sense like, yes, sure, AI will reduce the need for jobs or create a demand for a different kind of job. But it's still not going to transfer all manufacturing to the US. And we wouldn't want that either.
Although I think the more you see innovation in robotics, I think on the margin that allows more manufacturing to be brought to the US.
Mm-hmm.
Right? Because obviously the cost competitiveness of the US in terms of labor is the most difficult part of moving manufacturing to the US. So to the extent that you can extricate that labor component of it by increasing automation, on the margin, for every dollar or less of labor you have to pay and put towards automation, that much more asset you can move into the US for manufacturing. I mean, again, another example is, like I go back to this commercial laundry business I was talking about. You have, the productivity per hour of an employee can be massively improved by having an automatic sheet folder, versus in the past. So whereas, a lot of that was uneconomical, you now have the cost of labor, being taken out and, replaced with an operating cost being replaced by a capital cost. You spend, $200,000 for the machine and very quickly take out, three units of labor.
What's happening actually, China is also facing the same problem of high labor costs. So it's automating at a massive rate. So, actually a plant transferring from Southeast Asia, invested in by the Chinese, which is highly mechanized, coming here, it's not going to make that much difference in terms of employment. It's not that there's an opportunity of taking a labor-intensive activity in Asia or wherever, Latin America or Africa, and bringing it and using cheap capital to overcome the difference between labor and capital cost. It's the same. I mean, China is the engine driving this shift.
So I guess to your point, that maybe it's more important the network of intermediate goods being linked with final goods that matters more than
that may have an opportunity. Yeah.
We have a quick question coming in on Social Security. Seems like Social Security is running out of money. Will Social Security survive?
Yes, and my unit better hope so. By the time it becomes eligible, matters less to me. I think so. I mean, politically, it's a commitment. Other countries that are developed all do it. So I don't see that and it's not unaffordable. It's really a matter of, I mean, we've managed with it so far. I think there's plenty of gas left in that tank. Yeah.
Good to know as well. Go ahead, Moyer.
Nothing to add.
And then Moyer, can you speak to kind of expected costs of construction? Do you have any thoughts on where that's headed?
Construction for commercial,
residential and commercial real estate.
Yeah, I mean, I think for residential, a big component of construction cost is labor, land, labor, and financing, and all three are going up, right? So the supply of labor declining just means that cost of labor goes up, right? Particularly for, again, immigrant labor potentially. So that's one component. The second is, materials, and that's continued to go up. And last is financing. And, again, that's, as we talked about before, we don't see that coming down materially, maybe on the margin. So I don't see construction costs coming down. And I think the impact of automation, maybe there's a significant one. I haven't seen it, so I don't know if that brings down the per square foot cost of construction materially over the next 2 or 3 years.
Awesome. Thanks for that. Thanks for that answer. So we are at the end of the Q&A section of our presentation. Once again, thank you two so much for being here. I know I learned a lot, and I'm sure the audience did too. And so thank you so much for contributing your time, your resources, your knowledge to be here. As we close out, any sort of parting thoughts?
No, look, I think what's the old saying, right? The same Chinese character that represents caution or represents optimism represents caution, right? So I think one needs to be thoughtful about both caution as we approach the volatility in the market, but also where opportunity can live. And our Jamaat Chukramola has been well placed. There's good savings, and I think to the extent that we can take advantage of this, I think we come out better on the other side.
Yeah, I would echo Mayur's view. I think cautious optimism is called for, but patient optimism is also called for. I personally am waiting for tariff rates to come down to 20% between the US and China so I can buy a BYD electric car with a 5-minute charging connection. So yeah, no, so I think absolutely that this is a time where there is great uncertainty. Therefore, there's definitely a need for short-term caution. And you need to, again, the same message that please take the view of educating yourself thoroughly on the risks and rewards before going into something. Ignorance is no excuse.
And I'll just say that I'm glad that we have people like you two that are here that can share your thoughts and help us kind of understand what's happening during these periods of uncertainty. So once again, thank you to so much. Thank you to the audience for being here. Thank you for your participation, your questions. Don't forget about the survey. We will make sure that gets sent out along with the link, of course. But once again, thank you so much for being a part of today's U.S. Economic Outlook webinar. Thank you so much again. And Yali Madad.
Thank you, Zoe. Great job, moderating. Bye-bye now.